Hello everybody, in this video we are going to discuss about Ind AS 1, that is presentation of financial statement. What the Ind AS 1 is class. So here for the presentation of financial statement, the financial statement will include complete set of financial statement. What are the information will need to include in the complete set of financial statements we will discuss here. For financial statement, we will should have complete set of financial statement. So if company provided one financial statement, it will be said to be complete set of financial statement only if it have balance sheet, profit and loss account, statement of changes in equity, statement of cash flows, notes to accounts. This will be required, and this profit and loss account and this statement of changes in equity and this statement of cash flow statement and this notes to accounts and this balance sheet this only will be provided at the end of the period, and this is for the period and for the preceding period, and this will be comparing information will be provided here. The entity, whatever the format for filing for preparation of Ind AS, we need to comply the prescribed by division 2. So what we should follow, division 2 will be division 2. We need to write this like division 2 of schedule 3. Let's take division 2 schedule 3 we need to follow. So whenever we are preparing financial statement of Ind AS, we need to comply the division 2 of schedule 3 to the Companies Act. If you have any conflict in accounting treatment, or we are disclosing any Ind AS and schedule 3, then we need to, companies required to comply with Ind AS. So we need to comply with Ind AS mainly, and entity we need to provide comparative financial statement, comparative information for more than one previous year, and entity shall also present, sometimes it also present third balance sheet. What third balance sheet they will need to provide? Third balance sheet will provide at the beginning of previous year only if it is satisfied the conditions, then only extremely some cases they need to prepare the third balance sheet. So when we need to provide this third balance sheet will be provided only when entity applies the accounting policy. What accounting policies retrospectively? So whenever they are applying accounting policies retrospectively which has an effect on the items of balance sheet beginning of the previous year, then they need to present third balance sheet at the beginning of previous year, or making that retrospective restatement. First one will be retrospectively giving some accounting policy effect. Next one, we are making retrospective restatement which have an effect on the items in balance sheet at the beginning of the previous year, or we are reclassifying the items in the balance sheet, then also the entity need to present the third balance sheet. Normally we should provide two balances, but when we are having the triple R, that is one retrospectively have giving any accounting policy effect, or whenever we are making retrospective restatements which are having effect on balance sheet, or whenever we are reclassifying, then we need to present the third balance sheet. Now entity shall clearly write the currency in which financial statements are provided. Whatever the currency they are using, they need to provide that currency, whether it will be India rupees or USD, whatever the currency they need to provide. Now we are providing the financial statements. For the financial statement, what is the presentation of true and fair value, or whatever the features will be there in financial statement? First feature will be presentation of financial presentation of true and fair view will be the first feature. The entity shall comply with all standards. What they will need to, they need to comply all Indias and make an explicit and unreserved statement on such complaints in notes to accounts. So where we should forward this information in notes to accounts. So they will provide in notes to accounts such that they are complying all Indias and making that explicit and unreserved statement. However, if auditor with an auditor of entity may qualify, so auditor will qualifications, it may be modified or adverse or qualified or disclaim the opinion. So if he is qualifying the audit report because of some disagreement in the application of Ind AS by the entity, even though auditor is disqualified, the company may provide that they are following the all Ind AS. This is main feature. And after that, general features. First one, presentation and fair value. Next will be going concern. What is this going concern? Going concern means financial statement. We need to prepare the financial statement on going concern basis. That is, going concern basis means foreseeable future we need to see in the presentation of financial statement. If management has some significant doubt in the entity ability to continue as a going concern and the financial statement are not prepared on going concern, then the fact should be disclosed in the notes to account. First one will be presentation and true and fair view, that they tell that all Indias need to follow. If we are following all Indias, we need to make some statement that is explicitly unreserved. We are complying all Indias, even though auditor may give qualified. First one. Second one will be going concern. Going concern means we need to see the foreseeable feature entity will be in existing. If we do not have the foreseeable feature or we are not preparing going concern basis, then we need to note this in notes to accounts. Next, general features. Whatever the accuracy, frequency of reporting, entity shall prepare financial statement at least annually. So frequency will be at least annually, minimum annually. Some entities will prepare half yearly, semi-annually, quarterly also they will provide. Next, offsetting. Here, offsetting means entity shall not offset assets or liabilities, income or expenses unless required by Ind AS. So if they provide the Ind AS is allowed, then only the entity need to offset. Here after that we need to go with the whatever the accrual basis and materiality, consistency and comparative financial information. These are the general features of financial statements. And we need to provide the minimum comparative information 2 years and additional comparative information whenever third balance sheet. Additional comparative financial means third ever, when we need to provide a third balance sheet whenever changing accounting policy or we are given any retrospective restatement or we are reclassification, then we need to provide the third balance sheet. Now classification of assets. So this presentation, when the entity has extreme circumstances, it should disclose the entity. Going concern means what, changing accounting policy means what, accrual means what. Accrual means entity shall prepare its financial statement except for cash information and using the accrual basis. If the entity accrued some expenses, they need to give the entry effect in books of accounts, even though cash flow is not affected, even though cash flow is not happen. That is the accrual basis. Materiality means price and separate. If the item is material, then we need to provide in separately and present this items. If the item is important, then we need to provide. If not, as for individually it is not material. If we aggregate with some other, it is become material, then also we need to provide separately. And offsetting we are already provided. Frequency at least will be provided in one annually. Compared to information minimum 2 periods, and additionally third will come only there will be a retrospective restatement or reclassification, given retrospective restatement of accounting policies, change in accounting policies, this will be there. And classifications, identification of financial statement, whatever the name of the entity, whatever the whether the financial statements are individual entity or group entity, what is the date of record, and date of currency will be compulsory provided, and rounding will be presented. Accounting financial statement rounding acceptable as long as provided does not omit the case. Next, after that, here current assets operating cycle, we will discuss this one. Firstly, for assets means assets. Here assets, current assets. Assets entity shall classify assets as current. When we will classify as asset as a current asset, when if expect to realize the asset in its normal operating cycle, when normal operating cycle, then it should be classified as current. Or it expect to realize the asset within 12 months from the balance sheet. So within 12 months, if it is realized, then it will be treated as current. Or it hold for trading purpose, the asset is hold for trading purpose, then also will be classified as asset. In trading purpose means like inventory will be taking as example. Next, or assets which is have cash and cash equivalent will be shown as current assets. So whatever be there in current asset means if entity expect realized in normal operating cycle, first one 12 months, within 12 months realization, that also current. If using for trading purpose, that also come under current. And assets in cash and cash equivalent, all other assets are classified as non-current assets, will be shown as non-current assets for all assets. Now whenever we see the assets, next will be current liabilities. When the liability shown as current, if entity expect settle the liability in normal operating cycle, same normal operating cycle, if they are expect to settle. So for assets we are tell that realize asset in normal operating cycle. Here the liability settle the liability its normal operating cycle. Next, liability due for settlement within 12 months. If it is within 12 months settlement is going to happen, then it will be shown as current liability. And if the entity hold the liability for trading purpose, it was held for trading purpose, then also it will be shown as current. And it cannot defer settlement of liability for at least 12 months from the balance sheet date. For example, liability which became immediately payable if contract is cancelled. So you are entered one contract, we don't know contract when will be cancelled. If contract gets cancelled, we need to pay that amount. That type of amounts also will be shown in current liabilities. All other liabilities are classified as non-current assets. Okay, now in assets and in liability we see in that operating cycle. What is this operating cycle? Operating cycle means simply it means the time between acquisition of asset for processing and their realization in cash. This will known as operating cycle. So simply whatever the time gap between acquisition of asset and realization of cash, in between this time is known as the operating cycle. This is operating cycle. Operating cycle will include raw material holding period, or we need to add working progress holding period, and after that finished goods holding period, and after that debtors collection period. This all will come under operating cycle. If the company any advance is given for property purchase, equipment purchase, that it will become the capital advance. It will be shown as non-current assets, not the current assets. That is operating cycle. Next, what is current position of non-current financial statements or financial liability should be classified as current assets or liability. Based on our current position, we need to classify. For example, if we have any loans payable, that will become within 12 months we need to payable from the balance sheet date, then it will be treated as current liability. Is that was we are refinancing or we are rolled over for at least 12 months from the date of balance sheet. So we are entering some contract, we are refinancing the arrangement, then we are getting over at least 12 months, then whatever the existing lender or new lender, we need to see the amount at least 12 months. Existing lender, if you are existing lender, then we will go with the existing lender. If we enter that agreement, rollover agreement or refinancing agreement before balance sheet date, so if it is before balance sheet we are entered, then we are getting more than 12 months time, then it will become non-current liability. Or we are entering that agreement after balance sheet date, so as on date of balance sheet it will become the current liability itself. For if you are a new lender, you enter the agreement and you are getting the time at least 12 months, so you are getting at least 12 months, only 12 months means then it will become the current liability. If entity which is not refinance the loan but which have potential to refinance, so they are not refinanced, only they are getting the so they have potential to pay. Even though they have potential to pay, it will not treated as non-current liability, it will be classified as current liability. Now okay, if there is any breach, if there is any breach in material provisions or covenants or some conditions of loan payable, so loan payable is there, okay, loan payable is there, accepted after 12 months. So what we have done, non-current liability, but you have not followed some terms and conditions, you have not followed, then it will become payable on demand, then it will be classified as current liability. So it is actually non-current liability, but because of you are not satisfy some conditions, it will become on demand, then it will become the current liability. But if entity before date of financial statement, so before date of approval of financial statement, we are went to the bank, we asked with the bank and we got the permission, the grace period at least 12 months, then if we get the 12 months to rectify the breach, then this loan will be considered as non-current liability. Or if entry approach the lender for extension of complaint date in anticipation of the breach, so just they have doubt, so they are anticipating the breach complaining date, then the loan will remain as non-current liability. So only this liabilities provisions will be there, mainly the questions will be framed on this provisions. So simply what is there in India is one in summary provisions. So summary, simply we discussed in this entire standard complete set of financial statement. What we included in complete set of financial statement: balance sheet, profit and loss account, changes in equity and changes in cash flow statement, and notes to accounts. After that we discussed about we need to follow the division to schedule 3 we need to follow, and the company follow the Ind AS, and we need to present comparative financial statement for more than one previous year, and another more than one previous year means regularly we will provide 2 balance sheets. For some cases we need to provide the third balance sheet, sir.